There has never, ever, ever been a better time to retire. I am so stoked for you guys who are looking at retiring in a couple years, or right now, or last year, who have just recently retired. There has never been a better time to retire, and the reason is quite simple. It's because of Fed funds rate. So I just burped. Some guy got mad because he didn't like my ribs in my teeth. I said, I didn't have ribs in my teeth. I was just looking at my pearly yellows to make sure I did. And he goes, yeah, so rude. So now I just burped. You didn't hear it though. Oh my goodness, Josh, you're not very professional. Are you new here? When have I ever been professional? So check this out. Look at this Fed funds rate. What, 5.12 or something? I don't even know what it is. That's in July. 5.12. This is the St. Louis Fed Economic Research. But Josh was so much better back here. No, it wasn't. I'm going to share with you why. Look at that. Look at that. 5.12. What was it? Oh. So let's log this. All right. Again, you got to understand what log means. So we're going to format, log it on the left. On the left. On the right. Look at that. See that jump right there, the Fed funds rate? So a big jump right here. A huge fall, big jump. We've had falls since, look at that, 1980. We've never had a jump like this, ever. I mean, I just cannot stress enough how big of a deal this is. Look at that, dude. And this was good here, too. But remember, that's still, we're only at 2.5 back then. So remember, 2.5 to 5 is a 100% increase. All right, it's just remember that. So it's basically, and I wish they'd give you a thing where you can do a percentage increases, but 2.5 to 5 is a 100% increase. We were at 0.6 and now we're at 5.12. I don't even know how you calculate the amount of increase that is. I don't even know. That's a lot. A lot more than this right here. A lot more than this right here. A lot more than this right here. So why is that so important? Check this out. Here's Susie and Bob's sample. They're not real people, just FYI. My sample that I use in Right Capital. They get an 82% probability of success in retirement, all right? And their current allocation, which you'll see here in just a second, 82%. And let's see here, okay. And that's based on the guardrails. All right, so this is literally, don't make much notice of this, but it doesn't really matter that much. But I'm still using 82%. I want to show you why. So their current allocation is right here, 60-40 mix basically. We're getting 5.3% on our returns, our expected rates of return, 5.3, with a standard deviation of 10.7. So for simplicity, because I'm a caveman financial planner, we're going to say we're getting a 5% rate of return with a 10% standard deviation. All right, so 10% is our standard deviation, 5% is our rate of return. That means we take our bell curve. On any given year, we could be down 25% or up 35% because we times this by 3. So we take our standard deviation, times it by 3, that gives us 30. And we subtract or add to our expected rate of return, which is 5. I've done a million of these videos on this. I'm not going to get too deep in that here today, but on any given year, we could be down 25% or we could be up 35% with an expected rate of return of 5%. All right, so check this out. And if they got that kind of rate of return, and they did guardrails, they have an 82% probability of success. Interesting. What if they got, let's just put them all in the money market, which I think I have money market paying 3% or something like that. Let's just double check. I can't remember. They got, 3% I think is what I got in money market. Let's see what we got here. If we go to money market, on your left, 3%. All right, so now they're only getting 3% on the money market. And again, 3% is our expected rate of return. They drop to, that's not good. We don't want to be 65%. Interesting. So now let's put them all in stocks. And there's a reason I'm doing this, my friends. Hang tight, amigos. Amigos, 71%. Yikes. So all stocks is 71%. That's 6% rate of return. So why would a 6% rate of return give us worse than a 5.3% rate of return on our probability of success? Remember, our 5.3% rate of return, we'll go change this back to moderate, gave us 82%. All right, 86%. Okay, there you go. Did I not have moderate? I can't remember what I had anymore. Anyway, it doesn't matter. 86% probability. We go here, to money market, which only gives us a 3% rate of return, we go 65. We go here to all stocks, which gives us a 6% rate of return, we go to 71. All right, so we have 3%, we don't get enough rate of return on 3%. 6% is a good rate of return, but we have 70% more volatility. 70% because the standard deviation in a 6% rate of return was 17. And all stock market was a standard deviation of 17. All right, so 5.3 with a 10% standard deviation gives us 80% or 86% rate of return. We've eliminated some of the downside risk. All right, we've reduced our return, but we've eliminated some of the downside risk. So let me show you something here. Check this out. Here's a Vanguard money market. 7-day yield is 5.26. 5.26. Was I just telling you about the rate of return on a moderate portfolio? 5.3. Was the volatility? It was a 10% standard deviation, which means on any given year, we should expect a 25% decline. All right, that's what that means. 10% standard deviation, 5% expected rate of return. On any given year, we should expect the portfolio to drop by a quarter, lose a quarter of our capital. What's the volatility? So we have the same rate of return. What's the volatility in the money market? Let's take a gander, shall we? Compounded yield, what? 5.39. Wow, that's pretty interesting. There's the price, $1 a share. Okay, interesting. Let's keep going down. Keep going down. All right. Here's a, what? 52-week high, 52-week low. One. Huh. What is the price of the Vanguard money market has ever done? You want to take a guess? Let me show you. Look at the price of the Vanguard money market. Look at that, just flat. 1 second. Come on, man. Hold on a second. I gotta do like this. There we go. Oh, look at that. Just flat. This isn't just a price, but I just like to show you there's no volatility. Now we'll compare that to, let's compare the S&P 500. Use a pink. Why can't I go? Get why it's doing like that. Anyway, so here's the money market, just flat as can be. Here's the S&P 500. I'll get why it's doing what's doing that. Hold on a second. I don't know. I can't see the chart doesn't work for me. But anyway, check the money market. $1. Yeah. So if we go back to the money market and it has no volatility, there isn't any. That doesn't mean it can't. It certainly can. We had to break the buck with a federated money market account and 2009. I don't think Vanguard's ever dropped below $1. But that's a once in a lifetime. Anything could happen. I'm not saying it can't happen, but let's be realistic. The federal money market, you know what? Invest in? Check this out. 145 holdings. The average maturity is 21 days. Look at that. And what does it invest in? Let's go down here. If I can find it. Oh, where was it up here? I'll show you. You'll be like, wow, that's pretty cool. If I can, where the heck is it? Hold on a second. The Schwab money market, U.S. Treasuries. Look at that, U.S. Treasuries. Maturity date, September, October, September, August. You see where I'm going with this here? Short term, very short term government bonds that are guaranteed by the U.S. government. The most safest investment there is, risk-free investment, is short-term U.S. government debt. But the Treasury's broke. Well, if the Treasury broke, your stocks are broke too. That's just a fact. If the Treasury's broke, your FDIC is broke too. That's just a fact. Anyway, you're getting 5% now with no volatility. And if I get you successfully retired with just a 5% rate of return, why do you even need to take the volatility? I'm not saying don't have any stocks. I'm like, we don't need it right now. No, but the rates will go down at some point. Yes, exactly. What do you think causes the rates to go down, amigos? Probably a stock market correction, crash, depression, I don't know. Probably an economic recession, crash, I don't know. But when the markets when the economy starts tanking, the rates will probably be reduced. And you got all this money sitting in cash in the money market get 5% right now. You're like, I'm only getting 3 now. Yeah, because the markets are probably down 25 to 30%. If you can make it on 5% with no risk, why would you not do that? Love your thoughts. Let me know. See ya.